My name's Octavio Morenzi, and I want to talk to you today about a recent report we've published looking at FinTech within the capital markets. Within the space, we look at spending right across the whole gamut of different capital markets activities and try and identify where opportunities exist within FinTech investments and in FinTech spending. We've defined FinTech in a rather different way from most firms. Most firms consider it simply to be young startups, software vendors who are entering the space. But within capital markets, we do have a large number of very established players providing financial technology solutions. Obviously, there are the startups as well who are pushing into that space and trying to take market share away from the established software vendors and service providers. In addition to that, we have a unique sort of set of players in capital markets who are trying to take market share away from established financial institutions. And we'll go into those in a bit more depth during this presentation. In this first chart, we have mapped out the entire capital markets value chain and have identified the value and volume of IT spending, FinTech spending in the different segments you see on this wheel chart. We begin with capital structure overall, with equity issuance, debt issuance, mergers and acquisitions, advisory work and things of that sort. Here technology spending is relatively light, far lighter than the revenues generated by this segment. To a certain extent this is understandable since this is not a technology intensive business. This is very much about structuring deals, finding buyers, finding issuers and bringing those people together. This tends to be a fairly manual task, and the major expenditure in this area, the major portion of operational expenditures, actually investment bankers' salaries. There is some movement to automate certain processes and steps in here, but it will never be as intensive a spending area as some of the other areas that we've outlined here, for example, the pre-trade or at-trade space. In the pre-trade space, we start to see far more significant levels of spending, particularly in the area of analytics. Analytics is, of course, where investment managers, traders, and the like get their own investment ideas and figure out which positions to take and which positions to avoid taking. Obviously, you can gain a very substantial amount of competitive advantage here, and firms are inclined to spend heavily in this area to try and get that advantage. In the at-trade space, we find the largest segment overall is order and execution management, accounting for about $17 billion in overall spending. Over the past few years, we've seen lots of firms pile into this space and try and build ever faster execution management systems, getting as close to exchanges and execution venues as possible, trying to get ultra high speed executions. And this has led to very considerable spending in the space overall. To a certain extent, this is an area that's now run its course and spending is slowing down somewhat as the advantage through latency arbitrage that some firms were able to get in the past has basically evaporated as too many firms try and pursue the same trading strategies. In the post-trade arena, we also see a significant amount of spending, particularly in transaction processing, asset servicing, position keeping in those areas. To a certain extent, the reasons that we see high levels in the post-trade arena are not so much with any sort of competitive advantage that can be gained in post-trade processing and transactions. By and large, processing in the post-trade space has to be identical across firms or very, very similar indeed. There is not much room for competitive advantage in this arena. But rather sometimes the business owners are quite removed from the post-trade side of things and don't pay as much attention in terms of expense management. And those people managing the post-trade spaces have not necessarily been incentivized to keep their teams small and lean and mean as possible. In the risk management space, we've divided things into enterprise, market, credit and operational risk. And here also we see quite significant levels of spending as firms since the crisis have tried to get their risk under control. But even pre-crisis, we saw very significant levels of spending here in the risk management area, particularly in the area of market risk. Finally, we have RegTech or compliance technology. Here, we were surprised by how little spending is actually taking place. This is an area that has received a tremendous amount of attention in recent years, with more and more regulations coming online and firms having to deal with more and more rules and market structure changes that have been imposed by regulators. It is therefore somewhat surprising to see such limited spending overall. However, what has happened basically is as these new regulations have come online, financial institutions have simply chosen to throw manpower at them, throw bodies at the problem and try and resolve it that way. And the very nature of compliance does not lend itself initially to automation in a significant way. Many of the rules that have been created are somewhat vague and difficult to understand and change quite frequently in terms of the regulators' interpretation of them. And as a result, the actual automation of this has been somewhat lagging. So there's been hundreds and thousands of people at some large institutions dealing with compliance. Lots and lots of compliance officers have been added. Now we're going to enter a phase where I believe we're going to start to see firms trying to automate some of these things, increasing their spending on technology around regulatory compliance and trying to bring those head counts down. In this next chart, we have mapped out the established leading fintech providers. That is, the established software and service providers who are servicing these different segments of the market. Here you can see in many cases there are niche players who only focus on one segment, as well as some larger players such as Bloomberg, Thomson Reuters, Mises, Broadridge, FIS and a variety of others who play across a number of different segments. There are some areas that are relatively lightly inhabited. As I mentioned in the previous slide, the area of investment banking or capital market structure is basically an area where there is not that much IT spending, so consequently we see relatively few large software vendors in that space. There are some other areas such as order and execution management, which we pointed out before is the largest area of IT spending, but has a very significant number of different firms vying for market share within it. Then we go right across the different areas and you can see there are quite a large number of different software vendors playing in different segments here. In the next slide here, we transition away from the existing established software vendors to some of the FinTech Challengers. These are new technology companies providing services, software that they're trying to sell to financial institutions that are either more rich in functionality, offer faster technology, are cheaper, or use technologies in some way to competitive advantage to wrest market share away from the established players. Here we see a variety of different players again. I'm not going to delve into each one of these areas, but simply highlight some of the ones I think more interesting, but I'll refer you to the report to go into more detail. On the post-trade side, we've seen a large number of blockchain-like solutions or blockchain-based solutions trying to replace a very large segment of the post-trade arena, going right from clearing and settlement, position keeping, corporate actions, investor relations and securities lending, trying to move all of those things onto one single blockchain platform, obviating the need for any other solutions and indeed obviating the need in some cases for financial institutions at all or intermediaries to play a role there. I believe some of these initiatives are overly ambitious and are going to fall well short. Some of them might succeed in part for certain instrument classes. In the area of financial crime, I pointed out previously that RegTech is an area where there's relatively little spending, but in the area of financial crime, where we include things like trade surveillance and market abuse monitoring, things of that sort, we've seen a surprising number of new vendors jump in and try and get market share there overall. So that's a fairly crowded field. There are some very interesting solutions within there, but it is a very crowded field, and some of those, of course, are going to have to drop by the wayside. In this chart, we map out the various different emerging technologies that are impacting or widely being used in new projects and new initiatives in the capital markets value chain. In yellow, we see artificial intelligence. Here we see initiatives all over the place, from the pre-trade arena in terms of analysis, research, market data and messaging, as well as portfolio management, and in the whole entire post-trade space. The blue segments focus on blockchain. As I mentioned previously, we've seen a number of blockchain initiatives try and address inefficiencies in the post-trade arena, trying to look at clearing and settlement and position keeping and asset servicing, and trying to create sort of unified solutions that address all of these issues in one single place. Artificial intelligence is also playing a role here, as firms engaged in securities processing and servicing try and automate some of the areas such as reconciliations, exceptions handling and things of that sort that end up costing a lot of money to the industry. In red, we see basic sort of digitization. This is basically taking existing manual processes and trying to automate them. And here, really, the only area that is relevant is in the equity issuance space and debt issuance space, areas that tend to be very manual in terms of their approach, where some firms are trying to put in place technologies, for example, to automatically share data amongst the different participants in a syndicate, or trying to do allocations automatically, or trying to find issuers, or trying to find investors in a more automated fashion. But by and large, most of the areas we see in capital markets are highly automated. That's not to say that there aren't some instrument classes that are largely traded by voice and there's still some room for digitization. But if you look at the most liquid markets, they're by and large largely automated, and there's not much more room for digitization in most of those areas. The green area is behavioral analytics, and here we see some interesting applications in portfolio management. For example, using behavioral finance to try and determine do certain portfolio managers hold on to losing positions for too long. And if you can start to identify those kinds of behaviors, you can correct them and increase the performance of those particular traders or asset managers. We've also seen behavioral analytics being used to fight financial crime. to look at market abuse and try and identify patterns in certain traders and asset managers buying and selling of securities. And if you start to be able to identify certain activities that fall out the norm of the behavior for that particular individual, then you can raise a red flag and identify those. In the area of investor protection, also we see behavioral analytics playing a role as firms trying to get a handle on all the new investor protection rules and trying to address those by looking at the behavior of an individual investor and trying to understand what products and instruments are suitable for that particular person. In this chart, rather than looking at the steps in the capital markets value chain, we look at the capital markets by the different kind of participants. Investment banks, execution venues, such as alternative trading systems, exchanges, sales and trading, asset management, wealth management, and securities processing. In each of these areas, we have mapped out the overall level of industry revenues, which you see in red here, the red columns on the left axis, and the level of IT spending or investments in FinTech, the blue columns on the right axis. In some areas, as I pointed out previously in this presentation, you can see that the ratio of revenues to IT spending is actually fairly high. So if we look at investment banking, there's a very considerable amount of revenues generated there, but very low levels of IT spending. In sales and trading, this reverses. In sales and trading, we see far higher levels of IT spending as a proportion of revenues in other areas. In sales trading, as much as 30 to 40% of overall operational expenses are frequently dedicated to IT. We've also then pointed out who the major players are here, the leading existing financial institutions on the top half here. And on the bottom half, we identify FinTech players who have emerged using technology as an integral part of their business strategies to take market share away from those players. Some of the more interesting players we've identified, for example, in the FX trading arena is XTX Markets, a firm that has really only been around about 2 years, and in a very short period of time has been able to shoot up to the top of the FX ranking leagues in terms of volumes. So at the moment, the number 3 overall in FX spot trading, which is a remarkable achievement for a firm that's only a couple of years old. Here they have a very heavily technology-centric strategy using a lot of artificial intelligence and machine learning to look for opportunities in FX trading markets. And they're expanding out of FX into other instrument classes. Some years previously, I suppose, in the equities markets, we saw people like Knight Capital and Virtue and people of that sort take market share away in the equities trading space, going back about 5 or 6 years, focusing on high frequency trading strategies and trying to get ultra fast executions to gain some sort of advantage in terms of market making, market position taking. That is an area, as I pointed out before, has by and large run its course, where profits have plummeted as a result of too many people crowding into that space. In the asset management area, we see some very interesting FinTech players, though perhaps they wouldn't describe themselves that way in terms of hedge funds. Basically firms that are using all sorts of new alternative data sources, sometimes fairly esoteric data sources, such as satellite imagery, GPS tracking information, mobile phone usage data, credit card information, things of that sort, taking all of this data and plowing these into quantitative models that they then use to make their investment decisions. Some of the firms that stand out here are firms like WorldQuant and 2 Sigma, who are sort of leading the charge in their use of this kind of alternative data in quantitative investment strategies. And we have seen that these firms have been able to generate a significant advantage in terms of alpha over some of the competing hedge funds. As an industry, hedge funds have done fairly badly, but the real winners and stars in this area have been those firms able to take these vast amounts of alternative data sources or new data sources out there, make sense of it, and actually inform their trading strategies and investment strategies with that. In the wealth management arena, we've seen a number of robo-advisors jump into the fray. They've been able to attract some market share, but the response from some of the established players such as Charles Schwab, Vanguard, firms of that sort have been quite aggressive as well. Very unlikely that they were going to just roll over and let these robo-advisors take their market share away. So those kinds of firms have introduced their own offerings to try and fend off the robo-advisors that are entered into the fray. In the securities processing area, again, we see a number of blockchain initiatives cutting across the different areas, trying to address all of those areas at the same time, and basically getting rid of sort of custodian banks and security processes in the back end altogether. In some cases, they're going to have to deal with some regulations and regulatory issues. In some jurisdictions, assets must be serviced and must be housed with a custodian bank. So it's going to be interesting to see how they get around those kinds of issues. But they certainly are very active in this area, trying to create a new infrastructure in terms of securities processing and clearing and settlement in the back office and trying to drive those costs way down. In the investment banking side, we've heard some noise in recent years about equity crowdfunding and things of that sort. Those things have not really taken off in a sort of meaningful way at this stage. Though here again, in addition to these equity crowdfunding services, we see some blockchain solutions trying to create a more friendly or an easier issuance cycle that would really cut into investment banking fees and eliminate the need for expensive investment bankers. In capital markets, we see a number of emerging technologies have drawn a lot of attention onto themselves or are playing important roles in different lines of business. In this chart, we show the different emerging technologies from artificial intelligence, advanced analytics, visualization, right through down to alternative data, and try and determine what is the applicability of this particular technology by these lines of business. And these are the Harvey balls that you see on this chart. Some technologies seem to be entirely irrelevant, and some seem to be having a dramatic impact overall. We've also shown the overall level of spending that we expect to see in 2017, as well as the growth rate between 2017 and 2018. I would point out though that not all these numbers are mutually exclusive. Some of these are overlapping. So it's quite possible to use artificial intelligence for robotic process automation. It's quite possible to use advanced analytics in conjunction with alternative data. So these are not mutually exclusive areas, that are somewhat overlapping between them. But these are the major emerging technologies that are taking hold and shaping the industry. Some of them, such as cloud computing, you might not consider to be terribly new technologies. This is certainly something people have been talking about for at least a decade. I would say that here it's only fairly recently that we've really started to see industrial strength applications being hosted in the cloud by capital markets firms. In the past, they've been quite reluctant to do that. They've held on off too many new technology initiatives as budgets have been under severe pressure. But now we're increasingly starting to see new application development taking place in cloud-based computing solutions. The cloud is not appropriate for all kinds of deployments, and so it should be carefully chosen there. But we are seeing more and more firms increasingly choosing cloud computing as the place that they're going to deploy their initial applications. Finally, in this chart, we have taken all the different process steps that we identified in the capital markets value chain and tried to determine what is the attractiveness for external investors, such as venture capital firms or private equity firms, to invest in these different areas. We've ranked this by looking at basically three different criteria. One is the overall level of IT spending. The other one is what we call innovation IT spending, and that's basically new technology budgets trying to reform and reshape those processes, as well as the level of competition from existing or new and emerging FinTech players. And we've combined all of this to sort of rank them overall and look at the overall attractiveness for investment for external investors. I should point out this is not really looking at strategic investors. It might be that, for example, a firm is active in an area that we've ranked fairly lowly here overall, but it might nevertheless make sense for them to invest in FinTech processes and FinTech software in their particular line of business. So this is really looking for the external non-strategic investor interested in financial returns in this space. The top ranked area is analytics, pre-trade analytics. As I pointed out previously, this is an area of heavy spending in financial institutions, and it is an area that is relatively easy to break into in the sense that it doesn't require any major infrastructure changes. Some of the initiatives in the FinTech area that we've seen, such as blockchain initiatives, really require a lot of different market participants to collaborate with each other and replace very large elements of their overall infrastructure. In analytics, that's not the case. If, for example, some software vendor comes up with a better way of pricing collateralized loan obligations, it's relatively easy for an investment bank or an asset manager to integrate that piece of software into their overall processes. It does not take much renovation or plumbing change to make that happen. And as a result, we think this is one of the most attractive areas to get into, despite the fact that there's an intense level of competition here. In the post-trade arena and transaction processing, I think there's considerable leeway to actually reduce expenses. So this is an area where it's going to look at expense reduction more than anything else, and a lot of financial institutions are turning their attention to this area to try and get those costs under control. Then we have portfolio management, another area. The asset management industry has fared better perhaps than other areas in capital markets, certainly better than investment banking and sales and trading activities. And so we see a fairly robust level of IT spending there, and slightly less intense competition, though certainly the portfolio management system vendors out there would disagree with that, but slightly less intensive competition that we see in analytics, for example. At the bottom end, we have the different investment banking areas. Way bottom, we have mergers and acquisitions advisory work. As I mentioned before, this is a low-tech area. It's not an area that is really an area that's going to be able to be automated to any meaningful extent. It's all about finding deals, finding people who want to sell or buy or merge or acquire. That is the major, and actually structuring those deals. The same is true for exectuions, though we've seen more competition and more activity there trying to address those areas. Thank you very much for listening today. If you have any further questions about Optimus or about this report, please don't hesitate to contact me at the email address below or visit our website at optimus.com. Thank you very much.